Hey everyone, in today's video, I'm going to be talking about a stock that I've invested over $15,000 in. And if you're already looking at the screen, you will probably know I'm talking about Restaurant Brands International, ticker QSR. This is a restaurant stock that owns a lot of different restaurant brands with a global footprint. In this video, I'm going to be looking at my position, showing you kind of when I bought in, why I bought in, my thoughts about the company, as well as just some more background about the company and what their global ambitions are, finishing up with their valuations, and then any closing remarks. So if you like this type of content, just be sure to give this video a thumbs up. It really does help me with the YouTube algorithm. Looking at the stock's performance in the last year, the stock's up about 42%. It's done significantly better than the broader market and the restaurant space here. Past 5 years, it hasn't done tremendously well, just up about 22%. It also pays a pretty nice dividend. I believe it is a bit over 3% actually, so this may be a little low because it's probably pulling the US dollar amount. So probably about a 3.4, 3.5% dividend yield, and it does trade 20 to 25 times earnings. This company is one that I got into in this account at an average price of $75 at, and as you can see, I have 115 shares here. And you may be wondering, that's not $15,000, that's about $11,000. But I actually also own this company in my TFSA. You can see a screenshot on the screen here. So I own it there with an average price around the same price at $76, have 35 shares. So collectively, I own 150 shares, and the stock price is just over $100. So slightly over $15,000 in total value I have in this name. Now, going into this business a bit more, they own the brands you see on the screen. So Burger King, Tim Hortons, Popeyes, and then recently acquired Firehouse Subs, which is a bit of a smaller chain of premium subs that operate currently just in North America, but they're looking to grow that with time as well. You can kind of see the presence they have commercially, primarily Burger King from a store footprint point of view, and then Tim Hortons followed by Popeyes. But Tim Hortons is actually their biggest profit and revenue generator, just based off of the fact they actually own lots of their Tim Hortons locations. The majority of the Burger Kings, Popeyes, Firehouse Subs, and then a good chunk of the Tim Hortons ones too are actually franchised. So I really like that business model of not even owning the physical stores and the entire P&L, but just getting a slice off the top. It's really asset light. It minimizes CapEx requirements and whatnot. So that's one thing that I do generally like about this company. And as they expand globally, their percentage of revenue and profits that are being derived from royalties as opposed to operations continue to go up and up faster. This slide's actually a few years old, so they have more restaurants than what you're seeing in these slides. They've scaled up pretty nicely, but I thought this was a nice introduction just into where they have their restaurants in terms of percentage of Burger King versus the other chains. And then in terms of Firehouse Subs, you can see here they have about 1,200 locations, very heavily in the US, but they actually just announced this week, I believe, that they're opening, they just signed a deal with a master franchisor in Mexico, so they should be starting to open up a couple more locations there. In addition to that, I think they are going to be opening their first international location outside of North America in Geneva or Switzerland, somewhere in that area or one of those cities in Switzerland. So that should be an interesting experiment as well. But overall, when you look at the overall company, this is a much smaller bet. They're really betting on globalization and winning with Burger King versus other burger chains, and then also Tim Hortons and chicken with Popeyes. Looking at their overall restaurant count and just their track record, you can see, and some of this is a bit inflated because it's acquisition based with Tim Hortons coming on board there, Popeyes getting acquired in 2018, and now they've even added, which isn't in the numbers, but Firehouse Subs. But they do still have a lot of organic restaurant expansion globally as they expand all over Europe, all over Asia, Middle East, other regions of the world. They're getting more and more profit centers from owning the trademarks to more and more franchise operated businesses around the world. And as they look at what really matters and how they're creating value for those franchisees, increasing the awareness of these brands and the the perception of the quality of the food that they're running through their system in order to drive more foot traffic, more revenue per store, can get higher returns on investments, whether that's franchise costs, renovation costs, employee costs, just cost to manage the business, which improves profitability. And when you have a model that is highly profitable and has quick payback periods, it equates to franchisees wanting more and more restaurants to be opened in their areas, or to manage 3 Burger Kings instead of 1 Burger King, or tell their friends about how much money they're making and how this is such a good business opportunity, which fuels demand for franchise openings, which both fuels restaurant, but also gives a lot of quote unquote pricing power to franchisors, which would be the corporate company that you're buying stock in order to dictate prices and requirements and whatnot. So companies like McDonald's, who are super profitable, have a lot of negotiating power and power in the agreements with their franchisees based off of the brand and the efficiency and the profitability of the model they've created, and they're selling the franchisees essentially. And that's just a best-in-class example of, as a company has strong brand awareness, has a strong model to have high profitability, how they can use that as an accelerator for franchisee demand to fuel growth. Going into their financials super quick before double clicking in a couple other areas of their business, I really want you guys to focus here on the bottom right hand side. This is their adjusted EBITDA per segment of their business. So as you saw, whereas Tim Hortons is only about 25 to 30% of the store count as Burger King, they actually derive more EBITDA income because they own the full economics of that chain, right? So about $1.1 billion in the fiscal year 2022. Burger King was about $1 billion, and then you can see the significant drop off. Popeyes $250 million, Firehouse Subs $56 million bucks. So while Popeyes, Firehouse may have a broader growth trajectory, if you're investing in this company, you're really primarily investing in Tim Hortons and Burger King and their ability to deliver profits and growth, since those are the cash flows of the cash cows of the business today. Doing a bit of a double click on Tim Hortons, since it's such a big part of this company, you see Tim Hortons in 2015 pretty much was primarily in Canada, had a couple of locations in the US, and was in a couple countries out east. And you just contrast that to where they are today, went from 4,200 to 5,300 locations. This is also a couple years old, so this is probably a bit higher too. But that's about 25% growth in restaurant count over that time period. And they've expanded into a bunch of new countries in Europe and Southeast Asia. So really clear where their growth aspirations are. They obviously want a healthy business in Canada, which we'll talk about in a minute. But just from a total size of prize and shareholder return opportunity, being able to copy paste the successful model in other countries effectively just really opens the door to a ton of opportunity in how big this company can get and the returns on capital that they can derive for shareholders, because all the work they do on the brand, on the menu for the most part, and other things are fixed, and they're doing it for Canada and their existing franchisees anyway. So the broader and the bigger they get their system, the higher investments they can make in technology, the more leverage they can get on those investments, and it just really makes the model work more smoothly and enhances returns for shareholders. Going into some of the things that they've been focusing on over the last few years, beverage extension, so more cold drinks and other areas where they have low market shares, huge opportunity in afternoon food. Tim Hortons is really, really busy in the mornings and maybe afternoon for a quick coffee, but they really don't play in the afternoon food space, which is a huge category in their home market. Continues to be opportunities in modernizing the brand. Tim Hortons has great brand equity in Canada and is well liked, but it's kind of seen as dated to some extent. And then continuing to have strong community engagement, they call out there as a priority. Just kind of putting into a visual how limited their afternoon food segment is. They're only about a 4% share of the food market size in probably Canada here is what the chart's representing. And for the amount of stores that Tim Hortons has and for the amount of market share they have in just coffee, which you'll see in a second, this is an alarmingly low rate that they can definitely capitalize on, and they're doing more and more launches to try to capture more market share. Just looking at their presence here, you see in hot brewed coffee, they're at a 70% market share. So 70% of the coffee is going through Tim Hortons that's bought out of home, yet only 4% of the afternoon food. That shows me that they definitely have the locations, the distribution in order to have a much bigger chunk. Obviously not up to 70%, but like getting to 10% market share would be a huge opportunity. You see the size of prize of that market was $8.5 billion. So it's like a $500 million opportunity, which is a big block for a company this size. Some other areas that they have very strong shares: breakfast food, almost 60%, and then baked goods, 70%. Tons of people go to Tim Hortons for their donut, for their Timbits, and whatnot in the morning with their coffee. So looking at this company's earnings per share, you can see here they're going to do just over $4 this year. And they're going to have pretty strong growth to $4.50 next year, is what analysts are saying. Looking at the stock, that puts their current price to earnings ratio at about 24 times, since they're going to do a bit more than $4. And then next year, they should be right about 22 times. So 24 times current, 22 times future, which is still much cheaper than like McDonald's trading closer to 28, 29 times. I believe KFC also trading in the mid to high 20s. So you're getting a bit of a discount relative to those other players. One of the things that has really increased the price to earnings of this company, in addition to some good results over the last couple of quarters, but the stock went up about 10% when they announced that they hired Domino's former CEO, Patrick Doyle, as their chairman. Patrick Doyle ran Domino's super well, really focused on franchise profitability. You can really see under his leadership how that stock took off over the last number of years as he was there during this huge run-up. So the stock got really excited about that. I believe the stock went up about 10% in a day and really gained a lot of momentum off of that, thinking that he's going to come in, step change how they look at the business, how they look at franchisee profitability, and that will serve as an accelerator for restaurant growth and royalties into the future, coming back to the corporation as they globalize. So this is one thing I think is good for the company. Not sure how much they're paying him, but was good for the company. But didn't love how much it impacted the value of the company. Since I was buying this company, as you saw, the gains I had on it were pretty decent. I was buying this company at about 20 times earnings, now trading 24 times earnings, plus the earnings have gotten higher since then, which is why I'm up to the extent I am in some of those accounts. A couple other things I want to call out, in addition to having pretty strong earnings growth here, going from 414 to 450, that's like high single digit EPS growth year over year. And this 414, I think, is significantly higher than they've been in the past. So a couple years of really strong growth. I really like their capital allocation model, and they're really showing signs of allocating capital like an asset-light business that they're increasingly turning into as they expand to more and more restaurants outside of North America that they do not own. One thing that I like is they do share buybacks. So you see over the last 3 or 4 years, they've gone from about 470 million shares down to 455 million shares. So they're not doing buybacks in a huge way, but they are canceling out any dilution and then buying about 1%, 2% back from the open market. And it's not like they focus primarily on buybacks or return capital to investors. They also pay a growing dividend. So you see here, these dividend amounts aren't exact because they actually pay them out in US dollars, I believe. So depending on the exchange rate, it gets a bit skewed. But over time, you get the general sense. In 2018, they were paying about 57 cents and slowly has gone up into the 60s and now even into the low 70s. So despite the share price not going up huge over the last 5 years, as we were looking at off the bat, only about 4% a year, give or take. They have been paying out a 3-4% dividend, and they have been growing that dividend pretty decently over that time frame as they grow their EPS and their earnings. So one of the reasons why I bought the stock in the first place, capital allocation model, pays a good dividend. In addition to that, buys back shares. And in addition to that, is showing a really nice glide path to increasing cash flow through their globalization and increased royalty income that they're going to be getting from all these new restaurants they're planning on opening. So I think the dividend growth, the share buybacks will just accelerate from here as long as they execute as planned. I also think they own great brands. So Burger King is an old brand, but a brand that has a huge presence, a really global presence too. And I love that about the Burger King brand. I really get good global diversification from that brand. Tim Hortons has a really strong market position in Canada. Popeyes, while it's a much smaller bet, I think has a great opportunity for growth if I look at the restaurant count versus like a KFC, a Chick-fil-A, a Burger King, so on and so forth, given the quality and how many people love that brand and the affinity for that company. And then Firehouse Subs, obviously a super small bet, but I love to see them using their free cash flow, not even taking on debt, to bring on another brand, get some scale leverage and opportunities through their technology investments across all of these different platforms, and then cross-sell to existing franchisees. I think it really shows the power of the corporation that they're building by having integrated supply chains and integrated franchisees across many different geographies on these businesses can really compound how fast they can move and grow restaurant count long term. So those are some of the reasons I bought the company. Now, trading at 24 times current earnings, 22 times next year's earnings, I still don't think the company is overly expensive, to be honest. Even though the stocks really run up 40% in the last year, I think it was probably due for a bit of a run. I'm not buying currently. I'm going to wait and see a couple earnings reports. I think they report next week as well. So interested to see how that pans out. Just kind of waiting and seeing their restaurant growth, their same-store sales, their profitability, if they continue to do buybacks, etc. I wouldn't mind buying into this one, though, if they continue to perform well. I'd add more to this one. I'm not necessarily stopping at $15,000 if it happens to do well. But those are kind of some of the reasons, whether it's capital allocation, whether it's the strength of their brands, whether it's the globalization opportunity on restaurant count. Those are some of the reasons why I've invested $15,000 into this company. And it does pay me a pretty good return in terms of just dividends. I get over $500 in dividends a year from this stock. And it's one that I'm continuing to monitor, as I said earlier. So if you like this stock, would love to hear your thoughts in the comments. Or if you don't like this stock, would equally like to hear your comments, especially since I'm pretty heavily invested in it. And if you like this type of content, just reminding you to please give me a thumbs up on this video. It really does help out smaller channels with the YouTube algorithm. And consider subscribing if you haven't already. I will see you guys in the next one. Thanks.